A low credit score can raise your home insurance premium by hundreds of dollars a year, even if you've never filed a single claim. Most homeowners have no idea this is happening. They assume insurance pricing is based on their property and their claims history. It is. But in Canada, your credit score is also in the room. Most insurers won't tell you this directly. Your broker probably hasn't mentioned it. And the impact shows up quietly, in a premium that's higher than it should be. I've spent nearly a decade as an insurance underwriting analyst in the Canadian insurance industry. I've seen exactly how credit data gets used, what the thresholds are, and what you can do about it. 3 things: how credit scoring works in insurance, what it costs you, and how to fix it before your next renewal. And the third one, how to fix it, is the part most homeowners never act on. I'll show you exactly what to do in a moment. By the end of this video, you'll know exactly how your credit score is affecting your premium and what to do about it before your next renewal. Let's get into it. Here is something that surprises most Canadian homeowners. Home insurance and credit are not supposed to be connected. Your premium should reflect your property, your location, and your claims history. That's it. But most major Canadian insurers use a credit-based insurance score as one of their rating factors. It is legal in most Canadian provinces. It happens quietly. And it can add hundreds of dollars to your annual premium without you ever being told why. For most homeowners with good credit, this works in their favor or has no meaningful impact. But for homeowners with a bruised credit history, missed payments, high utilization, recent credit applications, it looks like a risk flag, and risk flags cost money. Here is exactly how it works. Insurers are not asking whether you are good at borrowing. They are asking whether your credit behavior predicts claims. That is the part most homeowners never hear. And the data behind it is consistent enough that most major Canadian insurers have built it into their pricing models. The result is a credit-based insurance score, not identical to your Equifax or TransUnion score, but derived from the same underlying credit data. This score is one input among many in the underwriting calculation. In practice, the impact varies by insurer. Some weight it heavily, others use it as a minor factor. A few do not use it at all. You will rarely be told explicitly how much your credit score is affecting your premium, because insurers are not required to disclose this in most provinces. The premium difference between a homeowner with excellent credit and one with poor credit can be significant. Studies in Canadian markets have shown premium variations of 20 to 40% attributable to credit scoring alone on identical properties in identical locations with identical claims histories. On a $2,000 annual premium, a 30% credit-related surcharge is $600 per year. Over 5 years, that is $3,000 paid for a risk factor that has nothing to do with your property. This is not a penalty. Insurers do not describe it that way. It is simply a rating factor that affects your tier. But the financial impact is real. Not all credit factors are weighted equally in an insurance context. 3 matter most. Factor 1, payment history. This is the most heavily weighted factor. Missed payments, accounts in collections, and payment defaults signal financial instability. In an insurance context, they correlate with higher claims frequency. A single missed payment from years ago has less impact than a pattern of late payments in the last 12 to 24 months. Factor 2, credit utilization. This is the ratio of your current credit card balances to your credit limits. high utilization, using more than 30 to 40% of your available credit consistently, signals financial stress. Low utilization signals stability. For insurance purposes, consistently high utilization is a negative signal even if you pay your balance in full each month. Factor 3. Length of credit history. Longer credit history produces more stable scores. A homeowner with 15 years of consistent credit behavior is a more predictable risk than one with 2 years. For newer homeowners or those who are new to Canada, a thin credit file, not a bad one, just a short one, can still result in a higher insurance tier than their actual risk profile warrants. Now, here is the part most homeowners never act on, and it is the simplest fix in this entire video. There are limits on how credit scoring can be used in Canadian insurance. Insurers cannot use your credit score as the sole reason for declining coverage. They cannot use it to cancel an existing policy mid-term. In some provinces, including Ontario, there are restrictions around how credit information can be used, and you may be able to request a credit-neutral rating option. Ask your broker what applies in your province. This means you can ask your insurer or broker to rate your policy without credit data. In some cases, this will produce a lower premium. In others, it will be the same or higher. But you have the right to ask, and most homeowners never do. Here is the mindset shift that changes how you think about credit and insurance. Your credit score is not just a borrowing tool, it is an insurance pricing input. Every missed payment, every maxed out credit card, every new credit application, these don't just affect your mortgage rate or your car loan, they affect how much you pay to insure your home. The homeowners who get the best insurance rates are the ones who manage their credit the same way they manage their property. Deliberately, consistently, with the renewal in mind. Credit improvement is slow, but the premium impact compounds in your favor every year you improve. Step 1. Check your credit report. In Canada, you are entitled to a free credit report from both Equifax and TransUnion once per year. Get both. Look for errors, incorrect accounts, duplicate entries, payments marked late that were not. Errors on credit reports are more common than most people expect. Each error you correct is a potential premium reduction at your next renewal. Step 2. Address the highest impact factors first. Payment history is the most heavily weighted factor. Set up automatic minimum payments on every account so nothing goes late by accident. Then focus on reducing credit utilization, pay down balances to below 30% of your credit limit on each card. Do not close old accounts. Length of credit history is also a factor, and closing accounts shortens it. Step 3. Ask your broker about credit-neutral rating. Call your broker before your next renewal and ask explicitly, is my premium affected by my credit score, and is there a credit-neutral option? In Ontario and some other provinces, you may have the option to request credit-neutral rating. Even if opting out does not reduce your premium, knowing the answer tells you something important about how your current insurer is pricing you. Step 4. Shop at renewal time, not mid-term. Different insurers weight credit scoring differently. Some weight it heavily, some barely at all. If your credit has improved in the last 12 to 24 months, lower utilization, cleaner payment history, no new derogatory marks, a comparison at renewal time will often produce a meaningfully better quote than your current insurer is offering. The 60 to 90 days before your renewal date is the right window. That is when you have time to run comparisons properly, complete a new insurer's underwriting process, and switch cleanly if a better rate is available. Your credit score is quietly shaping your home insurance premium, whether you know it or not. The good news is that it is also one of the most actionable risk factors on your file. Unlike your roof age or your postal code, your credit score is something you can directly improve. Check your credit report, fix any errors, reduce your utilization, ask your broker about credit neutral rating, and compare at renewal time if your credit has improved. If you found this useful, subscribe. I publish one of these every week. Everything I cover comes from nearly a decade of working inside the Canadian insurance industry. I've put a link in the description to compare home insurance rates from multiple Canadian providers. If your credit has improved since your last renewal, it's worth running the comparison to see whether that improvement is reflected in what you're being quoted. And if you missed the earlier videos in this series, I've covered how insurers price your premium, when to file a claim, how non-renewals work, the 6 property risk factors, and what actually happens when you switch providers. All 5 are linked at the end of this video. See you next week.